Good morning, everybody. Christine Thayers with Coldwell Banker. I am here with Lanie Conklin from Guaranteed Rate Affinity. We are going to discuss mortgages because I think it's something that's relevant and important as we enter into the new year. And people who have been waiting to buy or sell are probably ready and anxious. So let's get started. So tell us about yourself, Lanie, and Guaranteed Rate Affinity and what your status is in the company.
So I have been with this company for 5 years. This is my going into my 33rd year in the mortgage business. And you know, it's been a wild ride, right? I'm a senior vice president. They gave me the title senior vice president. What does it mean? It just means, you know, being in the business that long, having the volume, having the experience. It's just it's been all about, you know, educating the buyers.
You're an authority.
Yeah,
Really?
yeah. I mean, I certainly have become that. I mean, it's one thing I'm proud of, right? Because I focus on it. I love this business. I love coaching people and getting them into homes comfortably. And, you know,
part of what you do is coaching a new buyer, how to
absolutely
be prepared for the process.
Yeah, I like when people see me more as like a resource than just, you know, someone who wants to do their mortgage.
Right.
I always want the best for someone, right? So, but it's about educating, and I don't think enough people in my seat do that for people.
Right.
I think it's about educating and helping them understand the process.
Exactly. Couldn't have said it better myself. We're both in a service business. We both educate and service and provide information on the day-to-day. That's what's really important. So the transaction is almost at the end. It's so far down the line that it's like... We say 60 to 90 days. Sometimes it's 3 years. So
absolutely.
It could be that long. But anyway, okay. So everyone's top of mind question: how are mortgage rates, Lanie?
Mortgage rates. So mortgage rates have come back a little bit, right? We spent the better half of last year of this year in the mid to high sevens, and we touched 8 and beyond a little bit there.
Right.
So that became really challenging for people.
Right.
That was game changing.
Yeah.
Now we're down back, you know, just under 7% for most loans. I feel
for 30-year.
30-year fixed mortgage. You know, your 15 is not much behind that. It might be in the mid 6s. But for most first-time home buyer and other programs, we're just a tad under 7. We call it 6.9, 6.95. I tell people, can we all agree that it's about 7, right?
Yeah.
So, you know, that's a little bit more palatable,
sure.
I feel, for most.
Yeah.
So that's where we're at with that.
Right.
FHA is a little bit lower than that, maybe 6.75.
Right.
But with FHA, you trade off on usually the higher loan amount because you're putting this down, and you have higher insurance.
Sure.
For FHA.
Talk about jumbo loans, because I have buyers coming to me who are first-time buyers, and they can afford, you know, a $1.2, $1.3 million home, or sometimes the person who's you know, this is their second go around and they're scaling up. Talk to me about the jumbo loans and what that means today.
So a jumbo loan, it just means what loan amount we're at, right? So the cap for a conventional loan is 1.1. They just increased it this year to 1.149.
Oh, wow.
Right, on a single family home. It goes higher for 2, 3, and 4 family. So what that means is anything that you borrow over the conforming limit, which right now in a high cost area is 1.4 million, 49 million. Now high cost area is where we are, right? Bergen County, Passaic County, Hudson, Essex, Morris, most northern Jersey, even central Jersey. Anything really tri-state to Manhattan, to the cities, are high cost. They're designated HCAs, high cost areas.
So your loan limit's higher.
Loan limits are higher because your homes are more costly.
Right.
Actually, the normal conforming limit right now for anything that's not a high cost area is $766,000. So, but what does that mean in our area is a jumbo loan is if you borrow more than that $1,149,000 loan amount. So what does that translate to? It means if you're going to purchase a home for $1.2 million and change, you can put as little as 5% down and borrow $149,000 on a conventional loan. Anything over that, right? If you go to 1.5 loan amount, a 1.5 purchase price and put 20% down, that's $300,000. Your loan amount's $1.2 million. That makes you a jumbo loan.
Right.
Jumbo loans are just a little bit more restrictive in their guidelines. They want to see more that you have more money left over after closing, higher credit scores. They got more money out on you, right? So we want to we don't usually see many jumbo loans less than 10% down, because again, it's a big investment for us, for the investor to have our money out on 30-year money.
So a homeowner takes this loan and they say, oh my gosh, the interest rate, whatever it may be, 6.9, 6.5. There are ways possibly to manage that and alleviate some of the interest charged over time. How do you see that?
Yeah, so I mean, it's always great if you can make a little extra payment to principal every month, right? So say you have a $3,700 a month mortgage payment, pay $4,000, right? Pay it when you can. I believe the correlation is something like if you make one extra payment towards principal every year, you will decrease your term by like 8 years on a typical mortgage.
Wow.
So if you could just make that, so in other words, an extra payment of say $3,700 just a principal, if you prepay it by that much, what you're doing is you're pushing yourself down your amortization schedule, your principal balance that you owe faster, which means over time that is less interest.
Wow, that makes so much sense. So the buyer is in control of their interest payments, really, or their mortgage rate. In that sense, that's amazing.
Yeah. The faster you pay the principal, the lower your overall interest will be.
Yeah, that's great. That takes away a lot of fear. So what do you project for mortgage rates in 2024? I know it's very hard to project, and lenders hate doing this, but what do you see?
Yeah, we love the question, what do you think rates are going to do?
Yeah, because I know people are thinking it. Yeah.
Yeah, I mean, look, we've been thinking it too, right? When are they going to come back? Inflation's easing up a little bit. We have, an election year coming up next year. It's predicted that and forecasted that rates should ease up and stay somewhere in the mid to high sixes. It's just really hard to say what that's going to look like.
Right.
My advice is always to the buyers and to sellers who are going to become buyers. Let's qualify and get comfortable with what exists right now. If you're comfortable with this, then from there, you know exactly what you need to do and what you can feel comfortable doing.
Sure. And so when people listen to the news, and what should they be paying attention to that is going to directly affect that mortgage rate?
So that's such a great question, because every time you hear the Fed is raising the rates, the Federal Reserve does not control the 30-year mortgage interest rates. What they're setting is the government rates, right? The prime rate, the government lending rates. Those rates do not change 30-year mortgage rates. It impacts the market and the trading values of the bonds. And the biggest thing that people want to pay attention to is, number one, the economy. Inflation is a very heavy influencer on, because if prices go up, rates go up, right? That's your 30-year mortgage rate. But we watch the 10-year Treasury bond, how that trades. We watch how the 30-year MBS, the mortgage-backed security, trades. One of them's inverted, one of them follows in line with rates. So, really the best thing to do is get with someone like me. I can help you watch the right factors and indicators. But for the most part, when they say, hey, the Fed's going to raise the rate next month, that doesn't mean our rates are going up. In fact, we probably already knew about it, and it was already priced into what you're getting now. Okay.
Enough said. That's great. Yeah. What should a first-time buyer do to qualify for a loan? How do they prepare?
I mean, the thing is, you definitely want to try to keep your credit really clean. You don't want to start opening up a bunch of new stuff. I tell people, you can buy a car. Just talk to me first. Right? Make sure that payment makes sense and that it's not going to impact too much or to the point of that you can't qualify your ability to buy a home. Keep your credit card balances low. Actually, even better, instead of having 10 credit cards with small balances, keep 2 credit cards with big balances. That's actually better for the credit algorithm scoring than more cards with lower balances. Okay. So keeping your credit score, your credit card balances low is key. Try to maintain stable hours in your job. If you're not a salaried person, try to keep the same hours. And then if you don't, you fall into what we call variable income. It's a very big issue right now in the mortgage world. Since COVID, that became a very big issue. But really just understanding what you're comfortable paying, be responsible with your payments, pay on time. and understand what your payment shock is going to be.
Right.
You know?
So it feels like there's so many questions that people can ask you. It's only the tip of the iceberg.
Oh, yeah.
So, and I think the greatest thing about our business is for people in general is that we will answer your questions for free, no charge. So call for information. That's the best thing to do.
Yeah.
Anyway, final question. What would people who already own a home, or maybe they want to, buy up, buy down, whatever it may be, they're nervous. They don't know where they're going to go and how they can do it. How can we alleviate some of that stress?
It's a whole different conversation than the first time home buyer, right? Different concerns,
Right.
different things to think about. So the key is, I don't care how much money somebody makes or how much money somebody has. Nobody wants to make 2 mortgage payments.
No.
No one wants to keep a mortgage payment on a
Exactly.
home they're not going to live in anymore. However, that being said, you want, as you're converting yourself from a homeowner into a buyer again, you want to make sure that you are going to have competitive offers, right? You don't want to have to sell your home as a contingency of buying the new home,
Right.
because the other seller's not going to want to necessarily wait for that.
Sure.
Now, however, since we are still in somewhat of a seller's market,
Right.
it's a good thing to take advantage of the fact that, number one, you're not going to get more than you're ever going to get for your house than now.
Right.
Now is a great time to sell,
Sure.
regardless of your interest rate. And but
We
you
can
want-
always create that contingency too. As realtors, we say there's a contingency that the seller must find a home,
exactly
and you're never at risk of being homeless.
being homeless, and that's
Never.
the concern.
Right.
I always get that. I'm afraid I'm not going to have anywhere to live.
Sure.
Well, number one, you're in the driver's seat. You can say, look, I'll sell you my house contingent on me finding a house.
Yeah.
Now, you have to put a reasonable timeline on it. A buyer cannot wait forever. They have to worry about locking their rate.
Yeah.
They have to worry about when are they going to move. But as a seller, you just want to, what I try to coach people on is whether or not you can or want to carry both mortgage payments, do you qualify carrying both? Then we can help you, me and you, as the realtor and the
Right.
mortgage person, figure out the timing of, look, you're going to sell the house. Do you have the down payment to buy the new house without selling? If you don't, that's another stopping point.
Right.
Right,
Yeah.
so
yeah.
It's just a matter of
Every
figuring out the
individual
timing.
situation is different.
It really is.
Really, and they need our advice as far as that goes.
Yes.
I'm sorry, I have one more question.
Yeah.
Rent versus buy. A lot of people are feeling like, well, you know what? I'll just rent.
I know.
The prices need to come down. I'm not going to, risk this. What's your opinion?
The reality of prices coming down is probably unlikely. That's a crazy thing to wait for.
Yeah.
That's and certainly again in areas that we do most of our business in.
Right.
That's not predicted. It's not projected. That's not probably happening.
Yeah.
So that's another thing that even a lot of the market analysts and gurus will talk about is, you're missing out on the opportunity to buy at a price you probably won't see again. Now, yes, the interest rates are higher right now, higher than they were, let's say, in 20 and 21. But certainly not historically.
No.
They're still okay. Would we like, normally we like to see them in between the 4 and 6 range, the 4s and 6s. But if you're not owning a home, you're not building an asset. Your home is most likely one of the biggest nest eggs you have for when you retire.
Yeah.
Even more so than a 401k. Right. So that equity that you're building, you're missing out on all that.
Right.
Especially as prices appreciate.
Yeah. Can't agree.
So
with you
I
more.
think buying is always the right way to go. But again, you have to be comfortable with it, and you have to.
But you have to ask the questions.
You have to
So
ask
if you have
questions.
more questions, I can provide Lanie's information for you. Message me. Certainly, I would be happy to talk to you. And again, it's a conversation. So if you'd like to have a conversation, message me. Pose certain specific questions. I can pass them along to Lanie. You can ask me for her contact and so forth. But we're happy to be here today with you and hope that you can learn something and can move forward. Christine Thayers, there's no place like home.